March 16th, 2020, 9:37 p.m. Eastern Time. Something broke, not with a bang or a crash, not with flashing red lights or emergency sirens. It broke quietly, invisibly. In the deepest machinery of global finance, something fundamental stopped working. Traders stared at their screens in disbelief. Central bankers made frantic phone calls in the middle of the night. And for a few terrifying hours, the markets that are supposed to always work, the markets that governments and banks and trillion-dollar funds depend on to function every single second of every single day, those markets just vanished. Welcome to the Silent Collapse, where we uncover the financial disasters hiding in plain sight. Tonight, we're diving into the night liquidity disappeared, and why what happened then is far from over. Let me paint you a picture of what normal looks like. On any given day, trillions of dollars move through the financial system. Stocks trade, bonds change hands, currencies flow across borders. Futures contracts get bought and sold. And beneath it all, in the background, there's this thing called liquidity. Think of liquidity as the oil in the engine of capitalism. It's what lets you sell something when you want to sell it. It's what ensures there's always someone on the other side of your trade ready to buy. When liquidity is healthy, markets are smooth. Prices move in predictable ways. You click sell and boom, you're out. You click buy and you're in. No drama, no delays. The machine just works. But when liquidity dries up, when it vanishes, everything seizes. Prices don't just fall, they gap, they lurch, they disappear entirely. You try to sell and there's nobody there. Nobody willing to take the other side. It's like being in a crowded theater that suddenly catches fire and realizing all the exits are locked. That's what happened in March 2020. And it didn't just happen in one market. It happened everywhere at once. The story really begins a few weeks earlier. COVID-19 is spreading. Italy goes into lockdown, then Spain. The virus is hitting Europe hard and it's clear it's coming to America. Markets start to wobble. Stocks begin falling. Nothing catastrophic yet, just nervous. Investors are watching, waiting. Then comes March 9th. Oil prices collapse overnight. Saudi Arabia and Russia are in a price war. Crude oil futures dropped 30% in a single session. It's the biggest one-day crash since the Gulf War in 1991. Stock markets around the world go into free fall. The Dow Jones drops over 2,000 points. Circuit breakers trip. Trading halts kick in to slow the panic. But here's the thing. Even with stocks crashing, even with oil imploding, the bond market is supposed to stay calm. Bonds are supposed to be the safe place. When everything else is burning, you buy U.S. Treasury bonds. They're backed by the full faith and credit of the United States government. They're the safest asset on planet Earth. Except this time, they weren't. March 12th. Stocks are still plunging. The S&P 500 drops another 9%. Volatility is spiking to levels not seen since the 2008 financial crisis. And then something truly weird starts happening in the Treasury market. Normally, when stocks fall, Treasury prices rise. It's like a seesaw. Investors flee risk and run to safety. But on March 12th, both are falling. Stocks are tanking and Treasuries are tanking too. That's not supposed to happen. It's like gravity reversing. If you can't sell Treasuries, if the safest asset in the world has no buyers, then nothing is safe. Traders are panicking. Hedge funds are getting margin calls. They're being forced to sell whatever they can to raise cash. And because everybody is trying to sell at the same time, there are no buyers. Liquidity is evaporating. By March 16th, it's a full-blown crisis. And here's where it gets really dark. There's a market called the Repo market. Most people have never heard of it, but it's absolutely vital. Repo stands for repurchase agreement. Basically, it's where banks and hedge funds and big institutions borrow cash overnight using bonds as collateral. They hand over a treasury bond, get cash, and agree to buy the bond back the next day with a tiny bit of interest. It's how the financial system funds itself on a day-to-day basis. Trillions of dollars flow through the repo market every single night. It's the plumbing, the hidden infrastructure. And in March 2020, that plumbing exploded. Overnight lending rates, which are normally stable and boring, suddenly spiked. Institutions that needed cash couldn't get it. The people who normally lend in the repo market disappeared. They were hoarding cash, terrified of what might happen next. And if the repo market freezes, if that overnight funding dries up, the entire financial system can collapse within days. Banks can't fund their operations. Hedge funds can't meet margin calls. It becomes a death spiral. This is the liquidity crisis. This is the moment markets stopped working. Now, before we go further into what happened next, let me ask you something. If you're finding this story as insane as I did when I first researched it, do me a favor and hit that like button right now. And if you haven't subscribed to the Silent Collapse yet, click subscribe. We're building a community of people who want to understand what's really happening in the financial world, beyond the headlines and the surface level noise. Because this stuff matters. It affects your savings, your job, your future. All right, let's keep going. So it's March 16th. Markets are in total chaos. Liquidity has vanished. The repo market is seizing up. Treasury bonds, the safest asset in the world, are becoming impossible to sell. And here's what makes it even more insane. At the same time all this is happening, there's a massive rush for US dollars. Not just in America, everywhere. See, the global financial system runs on dollars. Companies all over the world borrow in dollars. Countries hold debt in dollars. If you're a business in Europe or Asia or South Americas and you have dollar-denominated debt coming due, you need actual dollars to pay it back. And in March 2020, everyone needed dollars at once. It's called a dollar funding crisis. Banks overseas are scrambling. They're trying to swap euros or yen or pounds into dollars, and the cost of doing that is skyrocketing. Currency markets, which are supposed to be the most liquid markets in the world, are breaking down. Spreads are widening. Transactions that should take seconds are stalling. The machine is grinding to a halt. And here's the truly frightening part. The Federal Reserve, the central bank of the United States, is watching all of this in real time, and they know they're staring into the abyss. If they don't act, if liquidity doesn't come back, the entire global financial system could collapse. Not slowly, not over months, over days, maybe hours. We're talking about a complete systemic meltdown, banks failing, markets closing, ATMs running out of cash, the kind of scenario that makes 2008 look like a minor correction. So what do? They unleash the biggest financial intervention in human history. March 15th, the Federal Reserve cuts interest rates to zero. They announced $700 billion in quantitative easing. That means they're going to buy Treasury bonds and mortgage-backed securities directly, pumping money into the system. But it's not enough. The markets are still tanking. Liquidity is still gone. So they go bigger. March 17th, the Fed announces they're opening up dollar swap lines with foreign central banks. They're basically agreeing to lend unlimited dollars to banks in Europe and Asia so they can meet the demand for greenbacks overseas. Still not enough. March 18th, they launched the Commercial Paper Funding Facility. That's a program to buy short-term corporate debt directly, ensuring companies can keep borrowing. March 19th, they announced they'll buy municipal bonds. March 20th, they launched the Primary Market Corporate Credit Facility and the Secondary Market Corporate Credit Facility. Fancy names for programs that let the Fed buy corporate bonds, both new ones and existing ones. They're stepping in as the buyer of last resort for everything. And then, on March 23rd, comes the big one. The Fed announces unlimited quantitative easing, not $700 billion, unlimited. They will buy as many Treasury bonds and mortgage-backed securities as needed to stabilize markets. They removed the cap, infinity dollars, whatever it takes. And slowly, painfully, it works. Liquidity starts to come back. The repo market stabilizes. Treasury bonds start trading normally again. The dollar funding crisis eases. And by early April, markets are functioning again. Stocks even start to recover. The S&P 500, which hit a low in late March, begins a rally that will eventually take it to all-time highs. The crisis is over, or is it? Because here's the thing nobody wants to talk about. The Fed didn't fix the problem. They papered over it. They injected so much money, so much liquidity, that they forced the markets to work again. But the underlying fragility, the structural weaknesses that caused liquidity to vanish in the first place, those are still there. Let's talk about why liquidity disappeared so completely. One big reason is leverage. In the years leading up to 2020, hedge funds and banks had been borrowing massive amounts of money to make bets in the markets. They were using strategies like basis trades, where they'd buy Treasury bonds and sell Treasury futures, profiting from tiny price differences. It seems safe because Treasuries are stable, right? But here's the catch. To make real money from those tiny differences, you need huge size. So they borrow, they lever up 10 to 1, 20 to 1, sometimes more, and it works great until it doesn't. And when markets started falling in March 2020, those leverage positions got hit. Margin calls came in. Funds had to sell. And because everyone was doing the same trade, everyone had to sell at once. There were no buyers. Liquidity vanished. The leverage that made the system seem profitable made it incredibly fragile. In to buy when everyone else is selling, they can't do that as much anymore. It's too costly, too risky under the new rules. So in a crisis, when markets need someone to step in and provide liquidity, the banks are constrained. They're on the sidelines. And that leaves the Fed as the only real buyer, the only entity with unlimited resources willing to step in. Which brings us to the uncomfortable truth. Markets no longer function on their own. They function because the Fed is standing behind them, ready to intervene. It's like a building that looks sturdy but is actually held up by invisible supports. Take those supports away and it collapses. Another reason is the rise of passive investing and algorithmic trading. More and more money has flowed into index funds and ETFs. These funds don't pick stocks. They just buy everything in an index. And when markets get volatile, when investors panic and pull money out, these funds have to sell. Not because they think it's a good idea, because they have to. They're mechanical. And algorithms, high-frequency trading systems, they pull back when volatility spikes. The machines that normally provide liquidity by buying and selling constantly, they shut down, they step aside. So just when you need liquidity most, it disappears. The very structure of modern markets makes them prone to liquidity crises. Then there's the regulatory environment. After 2008, new rules were put in place to make banks safer. They have to hold more capital. They can't take as many risks. That sounds good, right? But one side effect is that banks, which used to act as market makers, stepping... Now let's fast forward. It's 2021, 2022. The economy is roaring back. Stocks are hitting record highs. The Fed has pumped trillions into the system. Everything seems fine. But then inflation starts rising. Prices for everything, food, gas, housing, going up. The Fed realizes they have a problem. They've printed too much money. So they start raising interest rates. Fast, aggressively, trying to cool things down. And guess what starts to crack? Liquidity. Regional banks start to wobble. In March 2023, Silicon Valley Bank fails, then Signature Bank, then First Republic. Why? Because when interest rates rise fast, the value of bonds falls. And banks hold a lot of bonds. Suddenly they have unrealized losses. Depositors get scared and pull their money. It's a bank run. And once again, liquidity disappears. The Fed has to step in. They create emergency lending programs. They backstop deposits. They flood the system with cash again. Crisis averted. For now. But here's the pattern. Every few years, something breaks. Liquidity vanishes, markets freeze, and the Fed has to ride in and save the day. 2008, financial crisis, they intervene. 2020, pandemic crisis, they intervene. 2023, banking crisis, they intervene. Each time they say it's temporary. Each time they promise to unwind their programs and let markets return to normal. And each time, they can't. Because the system is addicted. Addicted to cheap money, addicted to Fed support. Take it away and everything collapses. So what does this mean for you? For the average person watching this video? It means the markets you see every day, the stock market, the bond market, the housing market, they're not as stable as they look. Beneath the surface, there's incredible fragility. There are trillions of dollars in leverage. There are structural weaknesses. And there's a central bank propping it all up. If you have savings, if you have investments, you need to understand this. You need to know that the next liquidity crisis isn't a question of if, it's a question of when. And when it comes, it might be worse. Because the Fed's toolbox is limited. Interest rates are already low by historical standards. They've already done unlimited QE. What happens when the next crisis hits and those tools don't work? Some people think the answer is Bitcoin or gold or other assets outside the traditional system. Maybe they're right. Some people think we need to break up the big banks and reduce leverage and simplify the financial system. Maybe they're right too. But what's clear is we can't keep doing this. We can't keep building a financial system that depends on constant central bank intervention to survive. It's unsustainable. And history shows us that unsustainable systems eventually collapse. Let me tell you about one more thing that keeps me up at night. It's called rehypothecation. Sounds complicated, but it's simple. It's when the same collateral gets used multiple times. You give me a Treasury bond as collateral for a loan. I then take that bond and use it as collateral to borrow from someone else. They do the same thing. The same bond is now backing 3, 4, 5 different transactions. It's like a game of musical chairs. Everything works fine until someone asks for their bond back. Then you realize there aren't enough bonds to go around. And the whole thing implodes. This happens all the time in the repo market and in derivatives markets. Nobody knows exactly how much rehypothecation is happening because it's not tracked, it's not regulated. But estimates suggest it's in the tens of trillions of dollars, so when liquidity disappears and everyone tries to claim their collateral at once, there's not enough to go around. The system seizes, and we're back to March 2020 all over again. There's also something called shadow banking. Now, these are non-bank financial institutions, money market funds, hedge funds, private equity. They do bank-like activities, lending and borrowing, but they're not regulated like banks. They don't have deposit insurance. They don't have direct access to the Fed. And they've grown enormous. Some estimates put the shadow banking system at over $60 trillion globally. That's bigger than the entire traditional banking system. And in a crisis, shadow banks are incredibly vulnerable. They can't call the Fed for emergency loans. They can't tap the discount window, so they have to sell assets. And if everyone is selling at once, liquidity vanishes. Prices collapse. The shadow banking system is a massive source of systemic risk, and almost nobody's paying attention to it. Here's another uncomfortable fact. A lot of the liquidity in today's markets is fake. It's provided by high-frequency trading algorithms. They put up buy and sell orders that make it look like there's depth in the market. But the second things get volatile, those orders disappear. The algos pull back. It's called ghost liquidity. It looks real on your screen, but it's not actually there when you need it. So you think you can sell your position because you see orders on the book, but when you try, they vanish. You get a worse price than you expected, or no price at all. This is especially true in markets like corporate bonds and less liquid stocks. The liquidity you see is an illusion, and in a crisis, illusions shatter fast. Now, I want to talk about central bank digital currencies, or CBDCs, because they tie into this. Governments around the world are exploring digital versions of their currencies. The idea is to make payments faster, more efficient, more traceable. Sounds good on the surface. But here's the darker angle. If the government issues a digital currency, they have total control. They can see every transaction you make. They can freeze your account if they don't like what you're doing. They can program the money so it expires if you don't spend it, forcing consumption. And in a liquidity crisis, they could directly inject money into people's accounts. No need for banks, no need for the traditional financial system. It's the ultimate tool for control. And while that might stabilize liquidity in a crisis, it comes at the cost of freedom and privacy. It's a trade-off most people haven't thought about yet. Let me bring this back to March 2020 one more time, because that night when liquidity vanished, we got a glimpse of how fragile everything really is. The global financial system, this thing we depend on for everything, our jobs, our savings, our retirements, it almost broke completely. And it was saved only because central banks were willing to print unlimited money. But printing money has consequences. It creates inflation. It creates bubbles. It creates more fragility down the line. We didn't solve the problem in March 2020. We delayed it. We made it bigger. And the next time it happens, and it will happen, the response will have to be even more extreme. So what should you do? First, educate yourself. Understand how the financial system works. Understand leverage and liquidity and central bank policy. Don't just trust that everything will be fine because the stock market is up. Second, diversify. Don't put all your eggs in one basket. Think about holding some assets outside the traditional system. Maybe gold, maybe Bitcoin, maybe real estate, something that isn't dependent on the banking system functioning perfectly. Third, have cash, physical cash. Because if there's a real liquidity crisis, if banks freeze, if ATMs don't work, you'll want something to get by. Fourth, reduce your own leverage. If you're carrying a lot of debt, especially variable rate debt, think about paying it down. When liquidity disappears, debt becomes dangerous. And fifth, stay informed. Follow what the Fed is doing. Watch the repo market. Pay attention to bank reserves and liquidity metrics. The warning signs will be there if you know where to look. Before we wrap up, I want you to do something for me. If this video made you think, if it opened your eyes to something you didn't know before, leave a comment. Tell me what surprised you most. Tell me what you think happens next. And share this video. Send it to a friend. Post it on social media. Because this stuff doesn't get talked about enough. The mainstream media doesn't cover it. They focus on the stock market going up or down, but they don't explain the liquidity underneath. They don't explain the fragility. We need more people aware of this, more people prepared. So drop a comment, hit that share button, and let's get this conversation going. Here's the thing I keep coming back to. We live in a world where markets are supposed to be free. Prices are supposed to reflect supply and demand. Winners and losers are supposed to be determined by who makes the best decisions. But that's not the world we actually have. We have a world where the central bank picks winners and losers, where markets are held up by unlimited money printing, where liquidity exists only because someone with infinite resources is willing to provide it. That's not capitalism. That's something else. And we need to be honest about it. We need to ask hard questions. Is this sustainable? What happens when it breaks? Who benefits and who gets hurt? Because right now, the people who benefit are the ones closest to the money. The big banks, the hedge funds, the asset holders, and the people who get hurt are everyone else. The savers who see their purchasing power eroded by inflation, the workers who see housing become unaffordable, the retirees on fixed incomes. The system isn't working for most people, and the cracks are getting bigger. March 16th, 2020 was a warning, a glimpse of what happens when the music stops. Liquidity vanished, markets froze, the system almost collapsed. And it's going to happen again, maybe next year, maybe in 5 years. But it's coming, and when it does, the response will be even more extreme. More money printing, more intervention, more control. Until one day, maybe it doesn't work anymore. Maybe the trust breaks. Maybe people stop believing in the currency. Maybe the whole thing comes down. I don't know when. I don't know exactly how. But I know the path we're on isn't sustainable. And the longer we stay on it, the harder the fall will be when it finally comes. So that's the story of the night market stopped working. The night liquidity vanished, and the world almost ended. This is the silent collapse. Thank you for watching. If you made it this far, you're exactly the kind of person who needs to be part of this community. Subscribe if you haven't already. Turn on notifications so you don't miss the next video. And remember, the collapse is silent until it's not. Stay aware. Stay prepared. I'll see you in the next one.